backdrop of uncertainty, how are we thinking about fixed income as an asset class over the next year?
There's great value back in bonds. Probably the most important point. The yield you start with is a reasonable floor on the real or the actual yield you're going to achieve over a 5-year period. In fact, correlations between starting yield and forward returns here in the United States are, up approaching 95%. You could achieve in a simple and relatively uninteresting passive index like the Barclays Aggregate Index a 5% type return. And by expanding into other sectors of the market, even high quality sectors of the market, you can get that yield up even higher than that in some instances. So that type of return has historically looked attractive in an absolute sense relative to even an elevated inflation rate of 2.5% or 3% instead of the 1.5 to 2 that we grew accustomed to pre-COVID. And that return has historically also looked very attractive versus either cash or equities, two reasonable alternatives to investing in bonds. In fact, more recently, just a few months ago, we finally achieved the situation where that relatively uninteresting Barclays Aggregate Index started to return more than the cash rate. For a while, the last few years, investors may have considered extending out the yield curve, but there was a cost to doing so, with cash being the highest yield on the board, so to speak. But the bottom line is you now get paid to extend out the yield curve so you can lock in these attractive rates and pick up some incremental income along the way. Then last but not least, and probably the most important thing I can say today is that I think it's important to note under any type of reasonable long-term valuation metric, equities look expensive. And when you've gone back over multiple decades of history and you've seen these yields as a starting point, 5, 6, 7% high quality bond yields on a global basis versus equities at the multiples that they're currently trading at, I think investors can step back and just be comfortable with the fact that, there'll be some ups and downs, but we really have a nice setup for an investor in a diversified portfolio of high quality bonds.
That's great. It is a tremendous environment for active managers to add alpha. So what are the sources of alpha that you're most excited about?
Well, again, the first one, of more macro nature is the fact that you just have, less influence from central banks, less volatility suppression. I think the second point is that there's a lot of room to take advantage of structural sources of inefficiencies in markets. And I think this is an important point. It's not tied to a macro forecast or a policy forecast, but the easiest way to generate active returns for end investors is to take advantage of the non-economic decisions of others. I think it's important to note, but it's also a huge structural opportunity for investors to do your own credit work. Today the gap is growing between what we internally believe is solid risk relative to how rating agencies may rate that risk. And again, that's going to create lots of opportunity for credit selection. So a lot of opportunity there in addition to a lot of the other structural inefficiencies that we're looking to take advantage of, here at PIMCO as well.